Welcome back to the deep dive. Today, we were really digging into the money side of things for two pretty interesting companies. DeFi Technologies, that's DOEFT, and MicroStrategy, their MSTR.
Right.
We're going to, crack open their financial structures, look at who owns them, see what makes them tick. It's all based on their latest overviews.
Yeah, the goal here is really to give you a clearer picture of what sets these two apart.
Because they're quite different beasts, aren't they?
Oh, absolutely. It's like comparing, well, two completely different blueprints for building a company in this space. One seems very focused on rapid growth, capturing the market.
And the other.
Maybe more about building a really solid foundation, long-term strength, maybe resilience. Let's start with just the size, the scale.
Okay, good idea. High-level view first. Market scope, financial health. So our data shows DeFi Technologies, DEFT, market cap is sitting around $103.3 billion. Now, if you put that next to MicroStrategy, MSTR, what the sources say MSTR generally has a higher market cap overall, significantly higher, actually.
Right, but that's where it gets really interesting because despite that market cap difference, their, let's say, financial vital signs, they diverge quite a bit.
How so?
Well, MSTR, for example, you see negative EBITDA in the figures and a lower current ratio, but, and this is key, they also have higher total revenue.
Okay, so more money coming in the door, but profitability not quite there yet, or maybe intentionally sacrificed.
Exactly. It often points to a strategy of aggressive reinvestment, like they're potentially trading those short-term profits for, trying to build long-term dominance. We see that a lot in tech, especially, well, with MSTR's big Bitcoin plays.
Right, the Bitcoin factor is huge there.
Definitely. Now, flip over to DEF. They've got a higher current ratio, which suggests more liquidity and less negative free cash flow, but they also have lower total revenue and lower revenue per share.
So DEFT looks maybe more cautious, prioritizing keeping cash on hand.
It could suggest that, yeah. Maybe a less volatile path, focusing on liquidity, fiscal conservatism, perhaps. It's a very different picture from MSTR's approach.
Wow, okay. So MSTR is pushing hard on revenue, even with negative EBITDA. That's, like you said, a bold strategy, very different philosophies. But what about who's actually steering the ship? Control, ownership. What does that tell us?
Ah, yes. Ownership details. This is crucial, I think. It tells you so much about potential control and maybe long-term vision.
So for DEFT, what are we seeing?
With DEFT, the numbers show about 92.07% of shares are free float, available for public trading. But interestingly, 7.93% are closely held.
Almost 8%. That seems significant for closely held shares.
It can be, yeah. It often implies that a decent chunk is controlled by insiders, founders, maybe long-term investors. That can sometimes mean quicker strategic decisions, maybe a more unified direction.
Okay, and how does MSTR compare on that front?
It's a stark contrast. MSTR's free float share is way up there at 99.79%. Almost everything is publicly traded. Only 0.21% is listed as closely held.
Wow, less than 0.25%. So MSTR ownership is much more dispersed then.
Oh, what does that mean?
Practically.
Well, it means the stock is highly accessible, very liquid. It attracts a really broad base of investors, from institutions to individuals, but it can also mean more diverse opinions among shareholders. Potentially more voices, sometimes conflicting ones, trying to influence strategy. It's just the other side of the coin compared to DEFT's potentially tighter control structure.
That makes sense. Tighter control versus broader access. And, you can kind of see how the market digests these different approaches. If you look at the share price performance chart we have, it's indexed from the start of 2025.
Yeah, that chart really visualizes those distinct paths they're taking.
So bringing it all together, how do these strategies stack up?
Well, you've got MSTR, characterized by that higher total revenue and that massive higher free float, even with the negative EBITDA. It really screams aggressive expansion, aiming for broad market appeal. It's a high-stakes approach, really. DEFT leans more towards that higher current ratio, suggesting stability, and the higher closely held share, maybe pointing to tighter control. This is despite having lower total revenue. It feels like they might be playing a longer game, perhaps a more conservative one.
So for you listening, what's the takeaway here? We're looking at two fundamentally different ways to build and run a company, right? Each path has its own pluses and minuses.
Exactly. And it really makes you think about the underlying capital structure. Is a company relying heavily on debt or preferred stock or sitting on a pile of cash and equivalents? All these choices deeply shape their risk profile and their potential for growth, especially in today's market.
It leaves us with a pretty interesting question, doesn't it?
Mm.
When you look at these two distinct profiles, MSTR's high-growth, high-float model versus DEFT's more controlled, perhaps stability-focused approach with its kind of structure, with its unique mix of revenue, ownership, and financial health,
Yeah.
which one might actually prove more resilient or adaptable when the market inevitably shifts again?
That's the key question.
It really makes you think about what truly defines value and stability in this constantly changing financial world we're in. Something to ponder.